respectively on year, but its net profit went down by a little bit compared to the same period last year. So the result is not that upbeat, but after the earnings release, KT stock is still bucking the broad downward trend, rising by more than 2%. This is because the company has announced to begin taking pre-orders for Apple's iPads this week. Well, it's not planning to offer the full line of iPad models, and an official launch date has not been set yet, but this news is what many Koreans have been waiting for, and the sentiment is pretty high now, as KT is expected to begin shipping the product to customers sometime in November. Meanwhile, sources are saying that KT's competitor SK Telecom is also negotiating with Apple in hopes of landing its own distribution deal, but no progress yet. Moving on to check in on Samsung Fine Chemical, it's seeing some massive gains of a whopping 11% at the moment after Monday's reports that it's in talks with MEMC to jointly set up a polysilicon production plant on the Korean peninsula. Well, it's over to Matthew in Sydney.
Actually, I'll tell you what, Matt's better looking, but I'll take it from there. Kimmo, thanks a lot. Kimmo on there up in Seoul, SBS CNBC. All right, where should you be putting your cash after getting all that action breakdown? Let's talk to Stephen Dover, International Chief Investment Officer, Franklin Templeton, Local Asset Management. He joins me here on the desk at the SGX. Stephen, great to have you on. Good morning. Nice to see you.
Nice to see you. Thank you for having me.
All right, listen, we've been talking about this all morning. Post what happened last week. QE2 kicks in. You've got the midterms out of the way and the possibility or potential gridlock in Congress. Usually good for equities. Seems like two huge green lights for money to go into risk, to go into equities.
Absolutely.
But it sounds like it's going to go more into EM than anything else.
Yeah, internally we think that probably about half of it is probably going to go into emerging markets, which is
including out here in Asia, of course.
Primarily out here in Asia.
Yeah.
Yes. So we've been quite positive on emerging markets. Let me give you a couple perspectives from a global investor perspective. I manage what we call our World Perspectives Fund, which in essence has allocation between different countries, different sectors. And we've been quite positive, in fact heavily overweight emerging markets over the course of this year, which has been very good for our fund. Certainly last week was very positive news for emerging markets. You know, the old saying, you don't fight the Fed, I think this is certainly that case. Whether it's going to be effective, whether it's actually going to stimulate the economy, whether it's going to grow, particularly the economy in the United States, I think that jury is out and is certainly debatable. But whether there's going to be a flow of money coming into emerging markets, I don't think there's much question.
But when that happy day does come,
yes,
and we hope it does come soon, we do see the U.S. economic recovery gain some serious traction. Then how serious will the fund flows away from emerging market be?
Well, I think that's the risk. And if I can just take a step at it, if we look at flows globally, for the year at least, now I don't know for the last couple of weeks, but flows have been negative into equity markets, right? Most flows have been into fixed income markets. But, so the pie has gotten smaller. But within that pie, the emerging markets portion has gotten significantly bigger. So if you look at different markets, if you look at the Korean market, the Brazilian market, the Indian market, the local investor has actually not put a lot of money into the equity market. It's all been the foreign outside money. And there's a risk to that, right? There's a risk. That's fickle money. So
exactly. And I was going to say, even before you get to the risk of the U.S. or the West recovering, there's also the risk that we could see, A, more capital controls out here in Asia. We've already started seeing them. And B, rates go up more aggressively than we had anticipated if some of the central banks, some people believe, are behind the curve, no?
I think so. I think that some type of capital controls is absolutely likely. We do a lot of work in Brazil. So Brazil, of course, has imposed this 6% capital control on fixed income. 2%. It was first 2% for equity and fixed income. Then they moved it to 6% for fixed income. So they're trying to, rather than manipulate the currency, have some type of control on the type of money that comes into a country.
Is that an example of a government striking the right balance, as opposed to directly intervening in the currency market?
I think so. I think that Brazil is a situation in which it has the highest, if not the highest, one of the highest real interest rates in the whole world. So the flow of money...
It seems to work in cooling down the...
Yeah, the flow into fixed income in Brazil, the number of Brazilian fixed income funds that were sold to Japanese or Asian investors was really out of hand, to be quite frank. So I think it is probably an example where that needs to be controlled.
Tell you what, given all the risks and the uncertainties to these money flows into EM Asia, And, let's be frank, you use the term fickle, and would suggest that at least some of this money is hot, okay? Let's imagine, let's say we run into each other at an airport. Our flights are delayed, we're stuck, and I go, oh, interesting. You're with Franklin, you're the CIO globally. Talk me through some of your funds, in terms of how do you hedge against these risks and uncertainties, given the potential and the attractiveness of EM Asia?
Okay, so let me take this from a different perspective, because I think that as an investor, it really depends where you stand, right? So your perspective as an Indian investor is very different than your perspective as a more global investor. Okay. So I'll talk about three different categories of funds: global fund, what we call local funds, and then fixed income funds. Okay, so my group primarily is responsible for what Franklin Templeton calls local asset management. And what we did about 15 years ago is we went into economies where we thought there was going to be a lot of growth, that's primarily emerging markets, and we set up local asset management companies whose primary purpose is to serve the local investor. And what we discovered over time is that an Indian local investor thinks differently in many ways than a foreign investor investing in India. The markets are different. As you probably are well aware, the markets in Asia tend to be faster than the markets globally. So what we've now done over the last couple of years is taken these local asset management companies and put them together, because now we have basically the whole world covered, and have a global fund which we call the World Perspectives Fund. So there's two different ways of how we look at things, from a local perspective and then from this global perspective. Okay. So the local perspective, as I said before, investors are actually not going into equity so much, they're going into fixed income. To take India as an example, there's a big flow into local Indian fixed income funds, and for good reason. You can get 8% return in India. That's roughly certain. Investors who've lost a lot of money over the last couple of years are putting their money into fixed income. Franklin Templeton as a whole, our biggest flows are into global fixed income. It makes sense. It makes sense because, if you will, investors have been underweight in diversifying their fixed income outside of their local currency. And it just makes sense because of what's happened in the equity markets over the last couple of years. So we see this trend in Brazil. We see this in a lot of different emerging markets. Then when we start to put all of the countries together and you ask, where should you put that money, we've been pretty overweight emerging markets. We think the case for emerging markets prior to quantitative easing and prior to this last week is very, very strong for where the growth is. What we think is that growth and the way that growth has happened is going to shift away from being export-driven, which is, if you think, the debate at the G20, everything that's happening is really this debate about, okay, are we going to, it's rebalancing. That's the story over the course of this next year or two. So it's got to move towards local consumption or local. If you, another thought that we have is a lot of the emerging market growth over this last few years has come out of China, or has been a China derivative. So if you think of Brazil, one of the reasons people invested in Brazil over the last couple of years is thinking of it as an exporter of raw materials to China or Australia, some of these, not as a consumer.
That's a
so
new story.
I think that's where we can have a huge shift, that emerging markets can become more balanced over the course of this next few years.
Quickly?
I think we're very, very positive on India. We're the largest foreign local investor there by far, both in fixed income and equity. The local investors there are primarily putting their money into fixed income at this point. There's great returns. We think that India is a great story. I went to China first in 1982, and like probably most investors, didn't see that future that was there. An exciting thing about India is that you can see that future, right? You can go to India, and it's no doubt that infrastructure spending is going to have a great return there, because they need roads. They need such basic things. But the return is so high.
Look at the equity market in India, Stephen. Aren't you a bit concerned that all the good news has been baked into prices? It's trading at around 20 times forward earnings.
A little rich, no?
Yeah. I've been thumping the table for India for a long time now. In fact, when I was here in March, we did some interviews where I was quite positive on India. It's hard to be as enthusiastic now, of course, when the market's at an all-time high. That said, we're still positive on India. So in our portfolios, while we're not adding to India, we're not taking away from India either.
All right. Listen, Stephen, wish we had more time. Hope to talk again very soon next time you're around.
Okay. Thank you very much.
Let's do it. Fantastic. Stephen Dover, International CIO of Franklin Templeton Local Asset Management, around the desk with us here at the SGX. Now, if you're still thirsting for some investment advice, log on to our website, CNBC.com. We're putting the spotlight on investing in wine in this